If you're serious about trading the markets in the next 7 days and in the next 7 months, this video is for you. It's quick but highly informative. We've identified two historic analogs which are going to show you exactly what the market is going to do next. Actually, as early as tomorrow, we could be expecting Black Monday gap down, guys. Key market levels will break this week, May 9th through May 13th. And more importantly, if you have a longer term outlook, I'm going to show you an easy strategy that could be implemented time in again and again for you to profit as a day trader or a swing trader. Now, also, I got some interesting comments on what the consensus is about this latest employment number, and a completely different way of looking at things is exactly what we do at 13 Market Moves. So let's go. Here's the schedule for Federal Reserve meetings, and we just knocked out the May meeting. We still got 5 meetings ahead of us tentatively. That should equate to a half a point increase in the next 2 meetings and quarter points in the following 3. So we got about almost 2 points of rate hikes. Now, the timing of this could not be worse than ever. And so the main argument, the consensus, most of the economists, they're currently focusing on the fact that they're saying, well, inflation cannot go any higher. And this coincides with the same time that oil prices keep going higher, prices all over the world keep going higher. Natural gas will probably reach all-time high this year. I mean, natural gas could go to $15, $20, and that's going to completely destroy this consensus that thinks that we're actually next Wednesday we're going to report the CPI number that's going to be the top. A much better number to focus on when we're talking about the tops is the employment top. So while the rest of the world is focusing on the inflation top, basically saying, hey, the inflation cannot run higher and higher and higher forever, we're saying, well, shit, you couldn't have been printing money for years and years and expect just a quick pump in inflation and for it to go away with the whole deglobalization taking place. The deglobalization is not going anywhere, and that's going to be the main driver for the inflation around the world. As you can see, it's not just here in the US that we've got an inflation problem. It's all over the world. I mean, every day, some countries reporting, well, we're at 18% inflation, we're at 11%, we're at 15%. I mean, Turkey's at 40% inflation. Guys, this is ridiculous. Okay, you cannot expect the inflation to top out here based off the historic analog, based off market conditions. And so if you really want to nail this market, a much better number to focus on going forward from here would be actually the employment number. And so let's glance real quick at the last employment report as of May 6. For the month of April, 428,000 jobs were added, which was in line. Unemployment, however, was unchanged. When something is unchanged after having a solid trend of unemployment going lower, 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 this is actually the first sign that a trend could be reversing. Now, if you understand thoroughly how this number is actually being calculated, you would know that this number is just an approximation. Labor Statistics is using a statistical algorithm which basically looks at the number of business closures, they look at the number of business openings, and they assume that the new businesses have opened based off historic data a certain number of jobs. So that number is by no means precise, and what we're saying, going forward, they often do these revisions with actual numbers, and going forward 30 to 60 days from now, this number is likely to be revised huge by at least a few 100,000 jobs. This number actually that was reported could be negative. So we could be going into a revision of this job report with a horrible, horrible number that the market does not calculate in the current market valuation. Now, remained at 3.6% in April is the key word to pay close attention to here. If we compare that to February of 2020, all right, this would be technically a double bottom or double top, depending on how you look at it from the stand of unemployment or full employment sort of thing, which I'm going to show you exactly how this looks on the chart to help you understand. But if you read through this, okay, in 2020, we're at 3.5%, we're at 3.6%, and basically pre-COVID, the economy was stronger by 1.2 million jobs. And despite of the trillions of dollars in stimulus, it still cannot get back to that level despite of all this crazy printing that's been going on. So In terms of the chart, this translates into this. So basically in February 2020, we were right here. Now this is a hypothetical chart. This is not an actual employment chart, guys, but this is just to illustrate the point. April 2022, okay, we're here. So in terms of chart structure, in terms of chart composition, what we're literally looking at here is employment top, top, top. Now, not looking at inflation top here as what most of the people are talking about on Bloomberg and CNBC and so on. I wish they were focusing more on this. Okay, so despite of all the printing, despite of all the economic stimulus that we've had, we're unable to reach the levels that we've had back in 2020 before COVID. So this potentially could be a lower high in relation to that best possible economic data that we've seen back in February of 2020. So basically what I'm saying, from here, employment is likely to drop, and if we were to draw a chart, it would look something like this. Now, if we look at it from the standpoint of unemployment, for those of you that are bulls, you're used to buying the dips, this chart is going to make a little bit more sense. So another way to look at it is this. The unemployment in February 2020 was at 3.5%. It rocketed, of course, after the COVID crisis. And since then, it's been coming down, and now the unemployment is back to this 3.6%. But this is for the first time it actually stops going lower. It stops right above the February 20 best possible case scenario that we've had. Now, if you're curious, well, how low can unemployment go? Well, the lowest unemployment on record was in 1953 at 2.5%. So just let's forget about all the charts and all the equations. Let's forget you know nothing about the stock market. Okay, the probability of unemployment going back to 2.5%, which has never happened since 1953, is definitely a lower probability than unemployment going higher from here. Okay, so we're not expecting a revisit of this 3.5%. We're expecting from here for unemployment to actually move higher. And the question here, if this is the bottom, right? If this is the bottom and unemployment from here can only go higher, then the main conditions that all the hedge funds have been using to keep buying stocks, okay, all of a sudden they're gone. I'm going to show you what they are. But let's just quickly see how fast can this situation actually deteriorate. And so based on the historic analog from 1973 to 1974, the reason we've picked that because they resemble market conditions precisely to that of current market conditions in terms of rate hikes, in terms of oil prices, in terms of inflation, and so on. Look at what happens. It looks like the economy is highly healthy. In 73, the GDP is at 5.6%, which is really great. Unemployment is at 4.9%, really great unemployment number. Inflation is at 6.2%. We're already above that level. Okay, so everybody's basically saying, well, CPI of 8%, I mean, that's not sustainable. And I think the market's going to have a reality check this Wednesday because that CPI number could actually come in higher. Now, look at what happens since 1973 through 1974, how drastically this picture deteriorates. GDP contracts 10 times. We're going from 5.6 positive GDP to minus half a point GDP. So we go from highly strong GDP to major contraction, and that happens over a period of 12 months. The unemployment, which seemed to be really great statistically speaking in comparison to other countries and in comparison here in the United States, 4.9% is a great unemployment number. But look what happens just 12 months later. It almost doubles, right? Unemployment number, I mean, it's up 60-70%. Unemployment now we're looking at 7.2. And at the same time, we're probably thinking, wow, inflation cannot go more than 6.2%. It actually goes to 11, and it tops the following year at 12%. So inflation still doubled from where people were thinking, wow, it's already high. So current inflation at 8%, we still are at unemployment of 3.5. We have a really strong probability as the interest rates, and I pointed out on the second slide, right, we got 5 Federal Reserve meetings, the interest rate's going to go higher. During such condition, okay, when inflation keeps going higher and Federal Reserve keeps increasing rates, there's no way we're going to get an unemployment of 2.5%. And then there's like a 90+% probability that unemployment is actually going to go higher. There's no way out of this. So the main argument that the hedge funds have been using to buy stocks, I mean, how many times have you heard it? Consumer spending is so strong. It is so strong, so strong. It makes sense. Well, the question to ask right now, what's going to happen to all this reasoning, all these analysts, all these hedge funds, all these market commentators, if we're actually going to get a weak consumer, which I've just outlined the fundamental case why the consumer will get weak and why the situation can deteriorate rather fast. So as a result of that, all those people that have been using this as an argument to buy stocks, they're going to unload stocks. So the question is, what are the chances that the stock market is going to be higher if unemployment actually doubles in the next 12 months? And it's got a really high probability of doing so. So maybe you were a bull before watching this, but now anybody still wants to buy calls? The only calls you could be buying, maybe calls on the VIX. But outside of that, guys, every sector of the market will get destroyed, maybe with an exception of defense stocks, because it looks like the globalization case is getting stronger and stronger, and the war is only going to intensify, and the time frame of the war seems like it's going to be extended for quite some time. So the defense stocks may be a great area, but where you're really going to make money is on the drops by shorting the market. So if you're new to the idea of shorting, guys, give us a quick call here at 13 Market Moves. Next week could be huge, guys. So if you haven't signed up to trade with a coach yet, make sure you do so. Based off the 2018 analog, we're going to have possibility of a Black Monday. And not on a Black Monday where we'd get a 27% drop tomorrow, but we're going to have a substantial drop. We could easily drop, another 5% tomorrow. We could drop next week 11%, as pointed out here. Next week could be comprised of candles that will resemble highly those candles back in the crash of December 2018. So if you're wondering how to trade this week, guys, well, you've got a big gap down that we're expecting tomorrow, Monday, May the 9th. If you take a closer look at the historic analog in 1973 to 1974 right here, this is where the market really takes a nosedive. Okay, it's about a 30-40% drop, depending exactly where you calculate the drop from. This is exactly what we're heading for. To help you understand how it actually looks on month-to-month basis, I've actually zoomed this slide out for you, and this is the bear market of 1974. And this is exactly how the rest of 2022 is going to look like. Now notice, as sharp as the drop as you can see right here, almost things going in straight line, lower, and lower. If you zoom in, right, you actually see that it's a series of bounces and drops. Bounce, drop, bounce, drop, bounce, drop, bounce, drop, bounce, drop, bounce, drop, bounce, drop. So if you understand how to short the bounces, guys, this pattern is going to be highly repetitive. If you really understand how to take advantage of this simple bear market pattern, your account is going to grow exponentially higher. And what better time to do it than to actually trade with a coach to make it happen, who's going to help you identify, okay, what is the bounce that you should short? Where's the drop that you should cover your shorts? Okay, how do you do it with weekly options? Okay, where do you actually get into the trade? But the pattern is clear. I mean, this is a billion-dollar pattern that I've shown you. This is what the market is going to do. And even the time frame matches, right? We're April, May, June, July, August, September, October. So that's 7-month drop in 1974. Overall, the market can go another 30-40% lower from here. So we can easily hit 3,000 on the S&P by October in the next 7 months. But it wouldn't shock me if we revisited the COVID crisis levels at about 2,300. So overall, that would be an almost 50% drop from all-time highs around 4,800 on S&P 500. So, but the question is, as a trader, don't again look at it as a one straight shot drop. This is what most of the people do that are new. They hear, oh, there's a crash, so I'm going to go buy these out of the money, way out of the money puts. And those are never going to work for you. That is not a way to make money trading options. So If you don't want to miss the killer trading opportunities over the course of the next 7 days and next 7 months, sign up to trade with a coach at 13mmtv.com. If you want to know which strikes to select, when to time the bounce, when to get out, when to time your entry, all of these things that are critical for you as a trader to actually not just observe, but to take action on every single day for the next 7 days and next 7 months, guys. Let's rock. This is your chance to take your account to the moon. I'll see you guys in the next video soon. Don't miss this big week. Let's roll.